In this video, we will look into bonds, different kinds of bonds, and many more details. Stay tuned. A bond is simply lending money to a company or a government by an investor for a set period of time in exchange for regular interest payments. Once the bond reaches maturity, the company or government returns the investor's money. Let's look at an example. Tesla plans to build a gigafactory. They issue bonds to raise money. Each bond is a loan for $1,000, which is called the face value. Tesla promises to pay back the loan in 10 years, which is called maturity. Tesla agrees to pay an annual interest rate of 6%, which is called coupon rate. Investor buys the bond for $1,000 and receives $60 each year till the end of maturity, which is 10 years. Once the bond reaches its maturity, the investor redeems his bond, and Tesla returns his $1,000 principal investment. In this example, Tesla got its money to build the gigafactory. The investor got his principal $1,000 plus $600 as interest in 10 years. It is a win-win situation for the company, as well as the investor. Let's take a look at different kinds of bonds and why they are issued. There are mainly 4 kinds of bonds. Corporate bonds, which are issued by public and private companies to fund day-to-day operations, expand production, or to fund their research. Government bonds are issued by the federal government. They are commonly known as treasuries because they are issued by the U.S. Treasury Department. Money raised from the sale of treasuries fund every aspect of government activity. Agency bonds are issued by government-sponsored enterprises to provide funding for the federal mortgage, education, and agricultural lending programs. Finally, municipal bonds are issued by states, cities, and counties to build roads, schools, and to fund local projects. Some of the government, agency, and municipal-issued bonds may have tax benefits. Now, let's take a look into bond ratings. Several credit rating agencies assign ratings to different bonds. These rating agencies use various risk metrics and analysis to rate the bonds. The ratings help investors to pick and choose bonds that fulfill their goals. It is also important to know that these rating agencies are not always accurate, so due diligence is required before investing in bonds. What are the risks with bonds? One risk investors face is the possibility that the issuer defaults on paying back the principal. This is also known as default risk. Bonds with higher default risk offer higher coupon rates. The amount of the risk depends mainly on the financial stability of the issuer. For example, most government-issued bonds are considered stable and safe, but come with a relatively low coupon rate. Corporate bonds typically represent a higher risk and offer a higher coupon rate. Let's take a look into interest rate risk with bonds. Interest rate risk is when the interest rate for the bond goes up. When interest rates rise, more investors allocate their money into the new, higher interest rate bonds. If you want to unload a low interest rate bond to take advantage of these new rates, you would have to sell your bond at a discount to make it worthy for another investor to purchase. Fixed income is a term often used to describe bonds, since your investment earns fixed payments over the life of the bond. Bonds are often considered as a safe investment compared to stocks. Many investors use a mix of stocks, bonds, gold, and real estate to pursue their investment goals. Hope you have enjoyed this video. Please subscribe for more financial and stock market content.